So we've learned how to enter transactions into ledgers, but before that, at the beginning of each month, there might actually be something called an opening balance. So how do we deal with that? Well, let's look at this. In most cases, a business will already exist before we need to start entering transactions. It will already have items in its balance sheet. We're going to call those opening balances. So, for example, on the 1st of January, a business had the following items in its accounts. It had an asset called bank, 25,000, an asset called accounts receivable of 50,000, a liability called accounts payable of 30,000, a loan of 10,000, and there was a capital account at 35,000. So what we would need to do before we even started entering transactions was we would need to enter these into ledgers with an opening balance. How do we do this? Well, we're going to use the rules of debits and credits. So we know there's assets, liabilities, owner's equities, negative owner's equities, revenues and expenses, and we're just going to apply our rules to this. So, looking at those rules, let's start. We say the first one is bank. So, bank, that would mean if we had an opening balance of bank, it's got a positive balance. Assets go up on the debit side. So on the bank ledger, we will do the date, 1st of January. And here, cross-reference, we're not going to reference another ledger, we're just going to write balance. And that tells the person reading it that was the opening balance on the 1st of January, and we put $25,000. What about accounts receivable? Well, accounts receivable was an asset. Assets go up on the debit side, so if it's got a balance of 50,000, that will go here. And again, we do the date, 1st of Jan, write the cross-references balance and the amount. Next one was accounts payable, 30,000. So that's a liability. Now liabilities have credit balances. So this time I'm going to put this on the credit side. I'm going to write the date, 1st of January, cross-reference will be balance, and I'll put the amount of 30,000. Next one is the loan of 10,000. That's also a liability. Liabilities have credit balances, so that would go here. And finally, I've got the capital account. So the capital account was $35,000 here. So owner's equity account, that's what capital is, that has a credit balance, so that would go there. And what we can see with our opening balances is we've kind of set them and now they're ready to enter the transactions for the rest of the month. And the main thing to remember here is all our debits equal all our credits. So I've got 25,000 and 50,000 here, so a total of 75. Here I've got 30, 10, and 35. That's also 35,000. So when we enter our opening balances, our rules of debits and credits also need to apply, and we need to make sure those balance too.